Well, let's shift our focus now to East Africa. Kenya, of course, is wrapping up the month of August with a rating upgrade from S&P and a positive outlook on its ratings from Moody's. While the country's fiscal health, however, is much more nuanced, with Moody's warning that improvements in the country's financial health are constrained both by wide distrust of and anger at tax policies, as well as limited room to cut public expenditure. Now, in part, that's because Kenya expends about a third of its tax revenues on servicing its debt. And at those levels, Kenya's interest to revenue ratios are the sixth highest in the world. That, of course, is double its levels in 2016. Now, given the twin constraints we just mentioned, Moody's forecasts that fiscal deficits will likely remain around 5% at the 5% level between the years 2027 and 2029. Well, CGTN's Ramanyang spoke with David Rogovic, a senior credit officer in Moody's sovereign risk team, and he started their conversation by exploring why it is so challenging for Kenya's government to cut its spending.
More than half of it goes to pensions, to salaries, and to interest. So first charges, stuff that you can't really adjust much. And in fact, the majority of that is now going to interest expense, where wages have declined as a share of GDP. So it's really driven this rise in interest spending has really driven a rigidity in fiscal flexibility or in the spending structure that makes it difficult to see how you can reduce the deficit from where we were last year at 5.8% of GDP. If you assume that revenues are going to stay stable here at 17% of GDP, let's say, then that adjustment to, let's say, below 5% of GDP, and then based on the government's targets to below 3% of GDP by fiscal 2029, would have to really fall on the expenditure side. When you look at the spending structure between the county transfers, the pensions, wages, interest, etc., it's hard to see how how we can achieve, or how we can see that fiscal deficit declining to such a low level by the end of the decade, let alone to the 5% and the 4.8% target for this fiscal year.
Indeed. So that's why in your forecast, you're essentially making the forecast that, look, the deficit will remain stable, you say, around the 5% level between 2027 and 2029.
That's right. And 5% would be an achievement if you think about Kenya's history. So last year, the deficit was at 5.8%, essentially unchanged from fiscal 24 and fiscal 23, and just marginally lower, half a percentage point lower than in fiscal 2022. So for the past 4 years now, we've seen essentially a deficit between 5.7 and 6.2% of GDP. We are forecasting an improvement to around 5% of GDP this year, which, in the absence of any adverse exchange rate movement, would put the debt level or continue the debt level's declining trend. The issue and the more relevant challenge for Kenya is not so much the debt level, which is high and it's risen, but it's more about the debt affordability, which we measure as interest payments to revenue. At 32 to 33% of revenue, interest in Kenya is, I think, the sixth highest among all rated sovereigns. You have countries like Pakistan, Sri Lanka, slightly higher, Egypt higher. But overall, of the 143 sovereigns that we rate globally, Kenya's debt affordability, or its interest revenue ratio, is the sixth highest.
Indeed, and we'll get around to conversations around the tax policy in just a moment. But to your point a little earlier, it's something that we saw and we've spoken about in detail with the World Bank last year, because they kept warning that, look, the spending on debt service is essentially crowding out spending on other things, healthcare, education in particular. But I want to get back to concessional financing, if I may. Because one of the interesting things that has happened, at least in Kenya this year, is the fact there's not a lot of concessional financing coming in. Development Policy Operation loan from the World Bank, that didn't check in. And IMF funding, if any, is pretty far out, probably 2026 at best, because talks on that will start somewhere around Q4. Should the baseline assumption here, looking at Kenya, be that concessional financing will be relatively difficult to get, at least in the medium term?
It's a good question. I think the way that I would look at the questions around concessional financing really is, so far in 2025, the absence of concessional financing, what has that meant for Kenya? It's meant that they've had to rely more on, the government has relied more on the domestic market for financing, and that comes at a higher cost than external borrowing. If you just look at the average cost of debt on the domestic debt stock versus external debt stock. I think on external debt, it's about 4% on average. That includes your higher cost Euro bonds, but also your lower cost concessional funding from the likes of the World Bank, the IMF, like you mentioned. Domestically, that's around 12%. And the cost of newly issued debt last year was even higher than that, around 15% on treasury bonds. So if you're financing a deficit at 5% of GDP, let's say if our forecast is correct this year, and 4% of GDP, so 80% of that is coming through the domestic market, you're paying somewhere between double digits, 12 to 15% on that debt. And that then means that your debt affordability, the interest to revenue ratio, is going to stay high, even if the debt burden declines very gradually. So you're left in a situation where there's not much room left to finance other spending, like we discussed. In Kenya's case, the issue or the concerns around the limited concessional financing this year are really tied back to debt affordability. Now, that sounds pretty negative. But the positive and why it's not having more of a negative impact and why we have a positive outlook on Kenya's credit rating is that even in the absence of this external financing, we've seen international reserves growing to $11 billion this most recently. That's up from $6.5 billion at the end of 2023, and up by over $1 billion in the year to date in 2025. So even with the absence of the IMF funding, even with the absence of the World Bank DPO, the central bank has been able to accumulate reserves, which means that then they have these reserves to repay external debt in the future if they can tap the domestic market.